Let me ask you something, and I want you to sit with it for a second before you answer. If someone told you 10 years ago exactly where you would be financially today, would you have believed them? Would you have done anything differently? Most people, when they hear that question, go quiet, not because they are embarrassed, but because the honest answer is yes. Yes, I would have done something differently. Yes, I would have started sooner. Yes, I would have been less afraid. And that silence, that pause before the answer, that right there is the most expensive moment in most people's financial lives. We are going to talk about that today. All of it. Not theory, not textbook material. The real thing, the stuff that actually separates the people who build lasting wealth from the people who work their whole lives and still feel like they are running out of time. And if you are over 50, I want you to hear this clearly. It is not too late, but it is also not the time to keep doing what you have been doing. So, let us begin. There is a mistake that almost every American makes, and it is so common that most people do not even recognize it as a mistake. They think it is wisdom. They call it being careful. They call it waiting for the right moment. What it really is paralysis dressed up in patience's clothing. You have probably done it. I have seen it countless times. The market gets a little choppy. The headlines get loud. Some expert comes on television and says things look uncertain, and you think, I will just wait. I will let this settle. I will get back in when things calm down. And what happens? The market recovers. It moves forward without you. And the money you were protecting by sitting on the sidelines ends up costing you more than any loss would have. That is the cruelest irony in personal finance. The thing people do to protect themselves is often the thing that hurts them most. Now, I do not say this to be harsh. I say it because the fear is real. The anxiety is real. Watching an account balance drop feels like losing something you worked hard to earn, and that is a deeply human response. There is nothing wrong with you for feeling it. But there is something worth examining in how we respond to that feeling. Because most of us were never taught to separate our emotions from our financial decisions. Think about it. Growing up, most of us learned about money from watching our parents. And our parents learned from watching their parents. And for a long time in this country, the dominant message was work hard, save what you can, put it in the bank, stay out of debt. That was the framework. And for their time, it made sense. But that framework was built for a world that no longer exists. A savings account that used to earn 5% now earns 0.5%. The cost of living has outpaced wages for a generation. And the idea that a pension will take care of you, that ship has largely sailed for most working Americans. So if the old playbook does not work anymore, what does? That is the question. And the answer is simpler than most people want to believe, but harder to execute than almost anyone is willing to admit. It comes down to this: time, consistency, and emotional discipline. That is the whole game. Not the flashiest ticker, not the hottest sector, not the app that lets you trade options in 10 seconds. Time, consistency, emotional discipline. Let me give you a picture of what this actually looks like. Imagine two people. Both of them are 52 years old. Both of them have managed to put aside $30,000 over the course of their working lives. One of them panics every time the market drops. They sell when things get bad. They wait to get back in. They feel smart when the market eventually recovers, because at least they avoided the drop. Never mind that they also missed the recovery. The other person does something almost boring. They invest that $30,000. They add what they can consistently every single month. They do not watch the daily numbers. They do not read the panic articles. They just keep going. 15 years later, both people are 67 years old. Both of them started in the same place. But the gap between them is not $10,000. It is not $50,000. Depending on what the market has done in those 15 years, the gap between them could easily be $200,000 or more. And that difference was not created by intelligence. It was not created by income. It was created almost entirely by behavior. That is the thing people do not understand about wealth. It is less about what you know and more about what you do, and more specifically, what you do not do when everyone around you is making fear-based decisions. Now I want to stop here for a moment because I know what some of you are thinking. You are thinking 15 years. I do not have 15 years. I am already behind. And to that I want to say two things. First, you have more time than you think. People are living longer, working longer. And if you are 50 today, there is a real possibility that you have 20, 25, even 30 years ahead of you. The idea that your financial life ends at 65 is an old story. The new story is different. The new story gives you more runway than any previous generation has ever had. Second, being behind is a feeling, not a permanent condition. And the way you change a feeling like that is not by wishing you had started sooner. It is by starting now with what you have and doing it consistently. The single worst thing you can do at 52 is decide that because you did not do it at 32, there is no point. That logic has cost more people more money than any market crash in history. I want to tell you about a woman, I will call her Carol, retired school teacher, 56 years old when she sat down and looked at her finances honestly for the first time. And I mean really looked. She had about $40,000 in a retirement account she had barely touched. Some savings, no real plan. Her pension was going to cover the basics, but she knew it would not be enough to live the life she had imagined. And for years, she had been telling herself that she would figure it out later. Later kept coming and going. When she finally made a decision, a simple, undramatic, unsexy decision to invest consistently in broad-based index funds and leave the money alone, her whole relationship with money changed. Not because the strategy was complicated. It was not. But because she stopped waiting for a moment of perfect clarity that was never coming. She made peace with uncertainty. She accepted that the market would go up and it would go down, and that her job was not to predict which direction. Her job was to stay in the game. That shift, that one mental shift, is worth more than any specific stock tip anyone will ever give you. Let me talk about something that does not get enough attention. The psychology of watching your money lose value, even temporarily. There is research that shows human beings feel the pain of a financial loss roughly twice as intensely as the pleasure of an equivalent gain. What that means in practical terms is that losing $1,000 feels about twice as bad as gaining $1,000 feels good. And when you understand that, you begin to understand why so many otherwise rational people make irrational financial decisions. The market drops 15%. You feel it. It feels like loss, even though you have not sold anything, which means it is only a loss on paper. But the brain does not always distinguish between paper loss and real loss. It just sounds the alarm. And when the alarm is ringing, the instinct is to make it stop. The quickest way to make it stop is to sell, to take the money out, to hold it in cash where you can see it and feel it and know it is safe. And in that moment, it feels like the smart move. It feels like protecting yourself. But here is the truth. In almost every documented instance across market history, the people who stayed invested through downturns came out ahead of the people who sold and waited. Not because they were braver, but because they had made a decision in advance about who they were going to be during hard times. They had decided before the volatility arrived, before the headlines got scary, before their neighbor called them and said, pull your money out now, they had decided that they were long-term investors. And long-term investors do not make decisions based on what the market does this week. That kind of clarity is rare, and it is earned, not by reading about it, but by genuinely examining what you believe money is for and what you are actually trying to build. I want to push on something a little uncomfortable now, because this is where the real growth happens. A lot of people in their 50s carry a quiet shame about money. Not embarrassment exactly, just this low-level sense that they should be further along, that they missed their window, that the people around them somehow have it more figured out than they do. And that shame, more than almost anything else, keeps people stuck, because shame is a conversation stopper. When you are ashamed of where you are, you do not talk about it. You do not ask for help. You avoid looking too closely, because looking closely hurts. If any part of that describes you, I want you to hear this clearly, directly. Where you are right now is not a verdict on who you are. It is just a starting point. Every single wealthy person you have ever admired, every one of them had a starting point that was not where they ended up. The gap between where you are and where you want to be is not a failure. It is just a gap. And gaps can be closed, but only if you stop looking away. Now let us talk about what actually works. And I mean practically, concretely, in real life. The first thing is this: simplicity wins, not complexity. The financial industry has a powerful incentive to make you believe that successful investing requires constant activity, specialized knowledge, and access to information that only professionals have. None of that is true. In fact, the evidence consistently shows that the vast majority of actively managed funds run by professionals who spend every waking hour analyzing markets, underperform simple, low-cost index funds over the long term. Not sometimes, consistently, over decades. What that means for you is that you do not need to find the next great thing. You do not need to pick individual stocks or time the market or find a hot sector. You need to buy broad, diversified, low-cost funds and hold them. You need to keep your investment cost low, because fees compound just like returns do, and a fund that charges you 1% more per year than another fund will cost you, over 20 years, a genuinely shocking amount of money. These are not small decisions. These are life-altering decisions dressed up in boring financial terminology. The second thing is consistency over size. A lot of people wait until they have a significant amount to invest before they start. I have seen people say they will start investing when they have $10,000 saved up. I understand the impulse. It feels like you want to do it right, do it meaningfully. But what you are actually doing is delaying the one thing that time-based investing depends on: time. The amount matters far less than the habit. $200 a month invested consistently will eventually beat a one-time investment 10 times that size. Not because of magic, because of the way compounding works, and because consistent investing means you are buying more shares when prices are low and fewer when prices are high, which is exactly the right thing to do, even though it does not feel like it. The third thing, and this might be the most important, is to get out of your own way. There is a phenomenon well documented in behavioral finance. When individual investors are studied over time, the returns they actually earn are almost always lower than the returns of the funds they are invested in. Read that again. People earn less than the funds they own. How is that possible? It is possible because of timing. People buy after markets go up, excited by recent performance. They sell when markets go down, scared by the same recent performance. They buy high. They sell low. They do the exact opposite of what works, and they do it with the best intentions, driven by completely understandable emotions. The solution is not become emotionless. It is to create a structure that protects you from your worst impulses. Automate your investments so you do not have to decide each month whether to do it. Set up a system where money moves from your paycheck into your retirement account before you ever see it. Create a written investment policy, even just a paragraph, just for yourself. That reminds you what you decided when you were calm, so that when the market gets scary, you have something to hold on to. That written policy, that pre-commitment, is one of the most underutilized tools in personal finance. And it costs nothing. Let me tell you about a second scenario. A man, I will call him Robert, who worked in construction for 32 years. Good income for most of it. Not extravagant, but decent. He got to 60 and had almost nothing saved. Not because he was irresponsible, but because life kept happening. Kids, divorce, medical bills, a period of unemployment, the things that happen to real people. And he had convinced himself that it was just too late, that he had missed it, that retirement was something other people got to do. He had a Social Security benefit coming, modest, and he had some equity in a small piece of property he owned, and someone sat him down and showed him what was actually possible. Not a miracle, not a fantasy. What was actually possible if he invested the equity, lived modestly, worked a few more years, and let the math do what the math does. And Robert's situation turned around. Not completely, not perfectly. He did not end up on a yacht, but he ended up with dignity, with enough. With the knowledge that he had made the most of the time he had left, rather than giving up on the time ahead. That is what matters. That is the actual goal, not a number. Enough. Dignity, security. So what does all of this mean for you right now, today? It means a few things. It means the window is open. It is still open, but windows do not stay open forever, and every year you wait is a year of compounding you will never get back. Not in a guilt way, in a clear-eyed, honest way. The cost of waiting is real, and it is measurable. It means that the most dangerous financial move you can make right now is not a bad stock pick. It is inaction, because inaction has a cost that is invisible in the moment and catastrophic over time. The enemy is not the market. The enemy is not inflation, though inflation is real. The enemy is the version of you that keeps saying later. It means that knowledge without action is just entertainment. You can listen to every financial podcast. You can read every book. You can understand every concept. None of it will change your life by a single dollar unless you do something with it. And doing something does not require perfection. It requires a decision. Here is what a decision looks like. It looks like opening an account today, not next week. It looks like setting up an automatic contribution, even if the amount feels embarrassingly small. It looks like choosing a target date fund or a simple index fund and leaving it alone. It looks like telling yourself out loud or in writing, or however it works for you, that you are a long-term investor, that short-term volatility is the price of admission for long-term gains, that you will not sell when things get scary, that you trust the process more than you trust your fear. That is a decision. And decisions made clearly, in advance, with purpose, those are the ones that change lives. I want to close with something that has nothing to do with numbers. The reason people do not build wealth is rarely a lack of information. It is rarely a lack of income. There are people in this country building million-dollar net worths on moderate salaries, and there are people earning six figures who have nothing saved. The difference is almost never what they know. It is what they do with what they know. And underneath all the strategies and percentages and tax-advantaged accounts, underneath all of it is a belief about whether you are the kind of person who can build something lasting, whether you deserve the kind of financial security that lets you stop worrying, whether it is too late, whether you are too far behind, whether someone like you actually gets to have that. And here is what I want you to walk away with today. Not a ticker symbol, not a fun name. The belief that you are running out of time is the only thing that can actually make you run out of time. Because as long as you act, as long as you move with clarity and consistency and patience, time is working for you. It may be working more slowly than it would have 30 years ago, but it is still working. The best time to start was 20 years ago. The second best time is today, not tomorrow, not when things calm down, not when you have it all figured out. Today, with what you have, exactly as you are, the market will do what the market does. It has always recovered. It has always, over long enough periods, rewarded the people who stayed in the game. That is not a guarantee of any specific outcome, but it is the most reliable pattern in the history of modern finance. And you do not need to be an expert to benefit from it. You just need to be consistent, patient, honest about your habits, and willing to get out of your own way long enough for the math to work. That is the whole thing. That is the secret that was never really a secret. It was always just discipline applied quietly over time. Get beats loud. Patient beats urgent. Consistent beats clever. Every single time.